For 30 years, Australia's economy moved in a single direction, stringing together a record-breaking expansion that seemed immune to the laws of gravity. But that 30-year winning streak is currently coming to a violent halt. Australia occupies a unique space in the global economy. It doesn't share the AI-led asset boom driving the United States, nor is it suffering from the industrial decay seen across Europe. Instead, the country relies on a specific hybrid structure. It combines massive commodity exports with a high migration population model and a deeply financialized property market. For decades, this model generated wealth not through gains in industrial productivity, but through the consistent appreciation of asset values. It was a growth engine fueled by rising prices rather than new output. Over time, the Australian housing market repurposed residential shelter into a highly leveraged financial instrument. This shift was driven by a specific tax formula. Investors used negative gearing to offset rental losses, while the capital gains tax discount left half their eventual profits untaxed. This expectation of indefinitely rising prices encouraged households to take on world record debt levels, operating on the belief that the tax code had effectively removed the risk of loss. However, this entire machine required one specific fuel to keep running: a world of ultra-low global interest rates. That low-rate world has been replaced by Neo-Stagflation. This is a global environment defined by persistent inflation, high borrowing costs, and stagnant productivity growth. High interest rates act as a direct toxin to Australia's debt-heavy model. The central bank is trapped. They cannot cut rates to support the property market without risking a secondary spike in sticky inflation. The era of the asset boom is over. Australia has transitioned into a new economic phase: asset stagflation. The 2026-2027 federal budget represents a government attempt to dismantle this over-leveraged property model before it reaches a breaking point. Policymakers are proposing a redistribution of the gains generated by property. They are moving to tighten trust taxation and scale back the generous tax discounts that made established housing a tax haven for investors. The goal is a structural reallocation of capital. Making traditional property less attractive pushes money toward productive areas like new housing and equities. But this carries risk. A cooling market lowers taxes and consumer spending. The wealth effect reverses. This slowdown in revenue is occurring just as government spending hits a wall of rising costs. Healthcare for an aging population, rising interest payments on debt, and new energy infrastructure transitions all demand more capital simultaneously. As the property-driven revenue model fades and these mandatory costs climb, the government faces the prospect of structurally persistent fiscal deficits. Australia is at a crossroads, moving toward one of three distinct economic scenarios. The first is Japanification. This would mean a long-term period of low growth, stagnant property prices, and rising debt burdens, where the economy stays afloat but never truly accelerates. The second path is UK-style stagnation. This scenario is marked by deteriorating public finances, weak wage growth for younger workers, and a permanent crisis of housing affordability. In both cases, the result is the same: an economy where asset prices remain high, but the actual living standards of the population slowly erode. The third path requires a complete pivot toward a productivity-driven economy, powered by the global demand for AI and new energy infrastructure. Australia holds the specific strategic resources this new era requires: massive reserves of lithium, rare earths, uranium, and a geographical scale that makes it a prime candidate for solar and LNG exports. Leveraging these resources could create a new cycle of industrial expansion, similar to the iron ore booms that built the country's previous wealth, but centered on the technologies of the next decade. The 2026-2027 budget cycle may be remembered as the moment the old property-driven model began to fade. It is a difficult transition, but it is the only way to replace a dying asset boom with a new era of actual economic growth.